Well, welcome to Chapter 1. Chapter 1 is very much an introductory chapter about financial management. Kind of just sets the table and helps you figure out what's going on. So some basic concepts for the most part, and for a lot of you, you'll probably recognize some of these concepts and terms from other business classes, from an accounting principles class, from econ, from intro to business. These are some things that you've seen before, but we just have to make sure we're on the same page and talk about them. So obviously we're talking about finance in our class. So I want you to see over here on the right hand side where the CFO of a company will fit in, the Chief Financial Officer, and typically reports directly to the CEO of a company. And then beneath the CFO, I want you to see kind of what are the main responsibilities that the CFO is in charge of. Accounting, treasury, which is cash management, credit, which is your banking management, legal issues, capital budgeting, that's how will we afford big ticket expensive items, and if we're publicly owned, investor relations. And we're really going to treat this class from the perspective of a publicly owned company. So anybody can buy our stock type of a company. So when we say investor relations, that's maintaining good relationships with our stockholders. Different than the COO, Chief Operating Officer, who's going to be more concerned with whatever it takes to make our product, deliver our service, anything related to that, delivering goods and services to our customers. We're going to be doing the accounting and finance for that, but we're not actually doing that. Now, we'll work together. Both sides have to be hand in hand in what they do, but just kind of keep that in mind too. Okay, so this is what I was kind of referring to when I talked about this is going to be some basic info. Proprietorships, partnerships, corporations. I'm certain everybody's seen this at this point in time. But you can take a look here. Proprietorships and partnerships. It's the advantages, disadvantages are essentially the same. There's really no difference. It's just a matter of how many owners are there. For advantages, it's very simple. They're easy to start. Very few regulations. They don't pay corporate income tax. Instead, the owners pay tax on their personal returns, but the business form itself does not. Some disadvantages, though, it can be difficult to raise capital. There's an unlimited liability issue and limited life. If a owner chooses to just stop doing the business or passes away, then that would be, the end of the business. So there are some disadvantages there too. Now, one big advantage that they don't mention here, and the reason that these usually exist, is what I'll call the unification of ownership and management. When you're the owner of your own business, you are making the decisions. So I think that's one of the positives for this, for these. But we're going to focus on corporations. The biggest advantage is unlimited life. The corporation doesn't end unless there's some kind of a buyout or bankruptcy, but it's very easy to transfer ownership. If you own stock of a corporation, you can easily sell it through your online broker. Limited liability. If you're the stockholder of a corporation, it's creditors cannot come after you personally for debts if the company goes bankrupt. Instead, you lose the value of your stock, but that's you're out your investment and nothing else. And it's very easy to raise capital. You can sell stock. You can borrow through banks easier. And those are things that the proprietorships and partnerships just cannot do easily. On the disadvantage side, a big one is double taxation. Corporations do pay tax. And then when a corporation pays dividends to its stockholders, the stockholders also pay tax on the dividends. It's also very expensive to set up and report. It requires a lot of legal filings and a lot of regulatory approvals. And then once you become a corporation, there's some annual filings you have to do and quarterly filings, which just take a lot of time, money, and effort. So it means you have to have more employees on staff. It means you have to have an SEC attorney on retainer, things like that. So it's just more of an expensive format. And stock prices and intrinsic value. And we're going to cover this in much more detail as we go through the class. But the word equilibrium, I think everybody has a rough idea of what that means. Equilibrium is when when the stock price is equal to its true intrinsic value. So if you were to look up a stock on a website and find out what it's worth, that's what the market says it's worth. The stock price reflects the market conditions, future expectations, economic events that are currently happening or that people think will happen soon, that all is within a company's stock price. But what's the true actual value of the company? You can figure that out. That's the intrinsic value of a company. It is very difficult to calculate because it requires making future estimations. But ideally, a stock is in equilibrium if the stock price on the market equals the true intrinsic value. So knowing that a company is in equilibrium or not is a difficult thing to figure out. So the bottom point that I want to mention here is that managers need to avoid actions that reduce intrinsic value, even if it increases stock price in the short run. So what I'm going to try to emphasize throughout the class is a well-run company makes decisions in the long term for the benefit of the long term and not the benefit of the short term. Because we can make decisions that will benefit the short term all the time, but they will be at the detriment to the long term. So a well-run company is always thinking big picture, long term, and making decisions that they know will pay off down the road to increase the value of the company. Okay. And so these are just some of the things that impact the value of a stock, of a company. And we'll get into this in way more detail in future chapters. So if you feel like, what in the world is this? It's okay. We're going to cover this down the road too. So keep in mind that management can make certain decisions that definitely impacts the stock price. Okay. Now also keep in mind there's certain things that management cannot control. The general economic environment, nobody can control that. The interest rate environment, the tax environment, the political climate, the desire for government to regulate or deregulate certain industries. Those all play a factor in what stock prices will be. And then we have on the left-hand side true cash flows and true risk. And cash flow is extra cash a company generates that could be returned to investors, and the risk of the company. Every company has certain risks. Obviously, some industries would have a lot more risk than others. And then we have that perception of what the cash flows are and what the risk is. And the perception will often be different than what the truth is. You know, and you can look at lots of examples in life that truth is different than perception. So on the left-hand side, the true things result in intrinsic price. The perceptions result in the stock market price. Okay, so we'll get into a lot of these topics in future chapters. And then another thing to keep in mind is if we were in the classroom together and I said, has anybody in this room made a decision that benefits themselves over somebody else, or that you're looking out for your own self-interest, sometimes at the detriment to others? We would all have to raise our hand because we're human beings, right? And it's just, we make those decisions. Even if we don't necessarily think that we do, sometimes we do. And so if I said to you, do you want to keep your job? And keeping your job requires you meet certain goals. And if you don't meet these goals, I'll replace you with somebody else. You're now motivated to meet your goals because you have a mortgage, you have a car payment, you've got to feed your family, right? So unfortunately, sometimes people, when they're working, are in this position where they know they have to meet certain goals. They have to meet certain objectives, and they do everything they can to meet those. But unfortunately, sometimes those objectives and goals are good. While they're good for them individually, they're not necessarily the best for the company. Okay, and that's the biggest conflict, or some of the biggest issues that companies deal with. Is we're supposed to be, as management, looking out for the best interest of the stockholders. Okay, that's the goal. However, I want to get my bonus this year. I got to meet certain goals to get my bonus. That means if I cut the price of my product so I can sell more to get my bonus, I'm going to do it. Well, I cut the price and now we're not making the profit margin we want to. Too bad. I got my bonus, right? So those are the issues that companies have to deal with. So we'll talk about that in future chapters too. And the same thing with debt holders. If you borrow money from the bank wants to get paid back. And the bank does not want you going crazy with the money. They want you to take the money they lend you and do something riskless with it, as riskless as possible. Okay. They don't want you going crazy because they want to get paid back. Stockholders, though, if they're buying your stock, they kind of want that stock price to go up. That's the whole point of buying stock. So they want you to take on a little bit more risk. they want you to do some things that will increase the value of the company down the road, so stock price goes up. So stockholders and debt holders quite often have different perceptions about what they want a company to do with money that has been given to the company. So again, we'll talk about that down the road too. And so how do you balance all that? And the other thing to keep in mind too is corporations, companies operate within society, right? They're employing people. They have suppliers depending on them. They have customers depending on them. And so you have to make decisions also about what's best for society, right? I want to increase the value of my company, but not at the sacrifice of the well-being of society either, right? So there's a balance there that we have to look out for. So being socially responsible, giving back, giving people meaningful employment with salaries that are decent enough for people to have a good life and well within reason. So those are all the things that kind of come into play. So chapter 1 just kind of sets the table for a lot of things. It's not necessarily stuff that is number crunching yet. We're going to get into that, but really just kind of set a foundation with chapter 1. A lot of these topics we've looked at specific chapters down the road in the class we'll cover in much more detail. Okay, and with that, if you have any questions about the chapter,